Hello, everyone, and thank you for joining us for an episode of the Financial Commute. Here to join me in this conversation today is wealth advisor and partner Mike Rudow. Mike, we have a headline episode this week.
I love headlines.
I
You know
know.
me. I saw when I pulled up CNN yesterday that Billy Ray Cyrus is now Instagram official with Heather Graham. Super excited about that one. So should we dig into that?
I don't know if our clients care as much about that one as they do. Trump sort of strong-arming Jerome Powell earlier this week with wanting to lower interest rates and causing some more volatility.
Yeah, so that might be a more relevant topic for today.
Yeah. I mean, and candidly, look, if I'm Trump, if I'm the president of the United States, and I've got $9 trillion worth of treasuries that are set to, expire and need to be refinanced at the end of this year, I'm going to want lower rates too. So I understand completely where he's coming from.
Yeah. I mean, it's one thing to understand where he's coming from, but it's also another thing to understand the role of the Fed and the role of the executive branch, and really having a firm understanding of that the Fed needs to be autonomous, needs to act independently and not act under pressure of the executive branch, right? Because the Fed's job is to look out for the long-term health of the economy. And with politics, a lot of times there are decisions that are made for short-term benefit.
Sure.
Right. So I think it'd be probably beneficial to take a step back and just look at what the role of the Fed is compared to what the role of the executive branch is.
Yeah, let's talk about the role of the Fed.
Yeah. So the role of the Fed is two-pronged, right? You've got monetary policy and you've got financial stability. So with monetary policy, the Fed sets short-term interest rates, right, with the goal of price stability, right? They want to keep inflation under 2%, and then full employment, right? And a lot of the times those are competing interests. Then with financial stability, the Fed regulates and monitors banks, right? They'll also act as the lender of last resort, right? When we saw the banking crisis, right, the Fed had to step in and kind of bail out a few of the large institutional banks, right? That's not what the Fed was put in place to do, but they're there as a backstop,
Right.
if needed. But the most important part about the Fed, too, is that they operate autonomously, independently.
Yeah.
I think one of the best analogies I've ever heard to give an understanding of the Fed, to kind of create clarity for me, was the Fed is like a referee in a football game, right? Where you've got this ref who is put in place to regulate a game to keep credibility for the game, right? And you've got two competing sides that are playing this game. And a lot of times you've got owners or head coaches that are coming down on the field and yelling at the referee. And right, these owners might have a lot of pull. And if that owner tends to sway the ref, right, and the ref now changes the calls that they're making based on the disgruntledness of the owner, well, now the game's losing credibility, and what could happen? You could lose season ticket holders. You could lose fans who are coming because they don't want to come see a game that's essentially being biased to one side. They want the credibility of the game to stay.
Yeah.
And that's essentially the Fed's role.
And so when you think about the Fed, right, you've got competing things going on. They've got their target for growth, it's around 2%. They've got to tackle inflation. We've seen inflation come down a little bit recently, but it's still relatively high and potentially ticking upwards because tariffs could increase costs, which could raise inflation. Okay. And then you've got unemployment. But like the Fed sort of backed into a little bit of a corner right now. We've got an economy that's slowing. We've got businesses that are having a difficult time making decisions because of the uncertainty around tariffs. You potentially are in a situation where you could see unemployment tick up. You can see inflation tick up, and you've got a consumer that's already kind of strapped with, credit card defaults or late payments at all-time highs, and the auto loans starting to tick up as well. And so, the Fed could be in a situation where the economy's slowing, and inflation continues to increase, and they can't lower rates during that environment. It could
Right.
cause more inflation. They potentially have to raise interest rates. So it's a really difficult spot for them to be in.
Yeah, and that's where the Fed needs to be data-driven and the Fed needs to keep a long-term focus, right? Short-term focus would say, hey, lower interest rates. We're in a slow-growing environment. There's a lot of strain on the lower and middle market consumers or middle-income consumers, right? It makes sense to think that with tariffs coming in and the uncertainty of supply chains and what costs are going to do and how they're going to affect margins, to be in more of a quantitative easing cycle, right, that will allow cheaper borrowing, which should allow more corporate spending, which should allow more personal spending, right? More borrowing equals more spending. That would be the easy fix, but the Fed is too fixed on the fact that we could have inflation take off again,
Yeah.
right? And it brings us back to times of the 70s and early 80s when we dealt with a similar scenario.
Yeah.
Right. And so the Fed there's no easy decision for the Fed right now, right? Because if they do cut rates, it could also look like they're giving in to political pressure. And that could also create instability because foreign governments could say, hey, there's no credibility to the Fed, right? And our treasury is our number one export, right? And so if they feel like the Fed has lost credibility because there's no independence on the Fed, well, that could cause a huge selling of treasuries. And what would that do? That would create an increase in the 10-year, which would create the opposite effect of what we were looking for.
Higher
right?
rates, higher borrowing costs.
Right.
And look, if I'm Donald Trump or I'm the president, like I said earlier, and I'm kind of looking out there long term, the U.S. has $36 trillion worth of debt. Right now, our interest payments on our debt's around $952 billion, which that's the second largest category of federal spending today.
Right, to Social Security.
And so if 9.2 trillion is set to be need to be refinanced this year, and it's at higher rates than it was 5 years ago during COVID when interest rates were zero, our interest debt continues to skyrocket. And so the long-term health of the U.S. economy is really in a lot of trouble. Right. The other reason why Trump would like rates to come down is because if rates come down, then all of a sudden you've got maybe increased borrowing, increased spending. It could be good for real estate, construction, other
Absolutely.
businesses. And that can help fuel an economy and create more jobs and help us avoid a recession that, some headlines have been out there saying we could run into.
Yeah. And Trump should want that. He should want a growing economy. He should want easier borrowing so that corporations could grow, they could build inventory, they could hire people so that there could be confidence in the consumer to go out and spend money, right? The problem is that if we lower interest rates too quick and for the wrong reasons, it might not have the intended consequences, right? It might actually create interest rates to shoot up.
Yeah, or inflation to continue to rise.
Because inflation would continue to rise. And when that happens, usually interest rates follow.
And, if the Fed lowers rates too much too soon, they all of a sudden don't have anything in their back pocket to help save the economy if we do head into a recession.
Right. And that's why I think, and I'm not saying I agree or disagree, I think that's the stance that the Fed has taken right now. We still need more data. We need to see what growth it was in Q1. Right, which right now projections is it was a very slow growth, but it wasn't a negative. It was 0.3 to 0.5, percent. So we're stalling, right? And inflation is stalling, right? And so the last thing the Fed wants is to get into an area of stagflation, a stagnant economy, stagnant high inflation, right? And so they're data driven and they're waiting to see, what information comes out, which will enable them to act in the best interest of the economy.
I'm so glad that we invest the way that we do, not only having exposure to gold miners to be able to kind of help combat the rising inflation or the depreciating dollar, but our access to private lending, real estate, other types of investments that are really resilient from the volatility that we've seen recently. I mean, we've been positioned this way for quite some time, mainly has to do with the zero interest rate policy that we were in for a very long time and the enormous amount of debt that the U.S. and other countries around the world have. But it's really showing for our clients to navigate these times of uncertainty, market volatility, and really weather the storm very, very well.
Yeah. I mean, how good does it feel? I know you manage, a lot of clients and they're very important to you. How good does it feel that when they're calling you, it's more about what opportunities do you see and it's less fear driven?
Yeah.
Because they trust, how we invest and they trust that we're looking out for their best interests. And they're looking at their portfolios now and they're like, we're doing pretty good,
I mean, not to pick on, other advisors because there's a lot of very smart people that do great work and they believe in what they do. But, taking that traditional 60% stock, 40% bond approach and feeling like that's going to be the way to navigate these uncertain times and the way going forward, like that's just not okay in my opinion. Yeah. And the fact that alternatives have become a really hot buzzword in our industry, we've been investing in alternatives for several decades. Yeah. This is not new to us. We know what we're doing. We know what we're looking for to help navigate these uncertain times. And we've been a proponent of gold for some time, whereas a lot of other advisory firms firms have not.
Right.
And that's been a big shift today.
Yeah, and whenever there's geopolitical uncertainty and risk of high inflation, right, the debasement of fiat currency, gold plays a wonderful hedge.
Yeah.
And we've been worried about the deficit that we spend and the debt that we hold and our place as a reserve currency globally. And so we've been investing in gold knowing that it could be a volatile, right? Gold's just as volatile as stocks, if not more.
Sure.
But because our fundamentals are investing in gold and gold mining companies and in our commodities were for the right reasons, I feel like we're now reaping the benefit of that when, we might have looked like we were missing out before when stocks are running up back-to-back years 20-25%.
Yeah.
But we did things for the right reason to protect, and now we're benefiting from it.
Yeah, and the whole theory around building a more resilient portfolio, like a bigger boat in times of uncertainty to navigate the storms or the murky waters. I know a lot of clients just had questions around, why is President Trump so advocating so much for lower rates? Like, what are the benefits there? And then what's the role of the Fed, and why does their viewpoint maybe differ than what's going on? And so I enjoyed this conversation with you today.
Yeah, me too. And just to wrap it up, I think any president sitting in his shoes would probably want lower rates because, helping to fuel and grow the economy is something that feels good in the short term and helps people in the short term. Which
it could potentially help in the long term too. I think about my kids and your kids and our future grandkids. I mean, if the U.S. has less debt or more affordable debt than what they currently have, obviously that's less spending that the government needs to do to service that debt.
Absolutely.
That could be better for them long term too.
And the whole worry is that if it happens prematurely, that the lowering the short term rate wouldn't create lower long-term rates, which is what would affect the mortgage rates and the borrowing rates in that way. And so I think we're sitting in a unique position where we can educate our clients. We can continue to build resilient portfolios and, kind of watch history in the making here of what happens with debt and tariffs and all of this fun stuff.
Also one of the big uncertainties is the Fed could wake up tomorrow and say, you know what, I decided to lower rates. But then inflation continued to go, and all of a sudden you could see things like the 10-year or 20-year or 30-year U.S. Treasury continue to why higher, even though the short-term rates came down.
Right.
So
and
there's no guarantee that that's going to happen.
That's why we build resilient portfolios.
Yeah, thanks, Mike.
Yeah, thanks for having me.